So thank you for watching part one with Ryan Long from National Gold Consultants, and I present the silver and gold advantage. There was a couple slides I expected him to be showing, and being an infinite banking concept authorized practitioner, many people find the concept of infinite banking through doing research on investing in real estate. And of course, others have some exposure to the stock market. And Ryan talked a lot about, trying to balance things, right? We talked about the 60/40 now going to 60/20/20. That was actually Morgan Stanley, not Goldman Sachs. That was just an accident that Ryan had said that. So the CIO, the Chief Investment Officer of Morgan Stanley, thought that a good balanced investment portfolio, whether it be retirement accounts or what have you, should go from what is traditionally a 60/40, which is 60% stocks and 40% bonds, so that when stock market goes down, often bond rates go up, and so they offset some of the downturn in the stock market. But Mr. Wilson from Morgan Stanley is now putting it out there through, and I'll try to put a link in the description. He is changing that 40% of bonds to 20% bonds and 20%, excuse me, gold and silver, precious metals, to offset a downturn in the market. Ryan has been talking about, uh, much more than, the traditional 10 to 15% for a while now. And I'm going to show you some slides or some screenshots in a moment here that will show that if you had 10%, and then if you had 20% in one of the worst downturns we've had in our lifetime, or at least in mine, uh, yeah. So let me get right to that without just continue to yap here. So what happened um, between 2008 and 2011, right, was a significant downturn. And before I get on to this page, which is really about, so how much should you allocate to gold and silver? And in Ryan, in his presentation, part one, enough to make a difference, right? He said, well, if you're not even going to do, you know, a certain percentage, you might as well not even bother. I don't fully agree with that because I feel like some is better than nothing. And, you got to start somewhere. If you have a portfolio where yeah, if you had 100,000, move 20% of it, maybe move 30%. Because as an infinite banking concept practitioner, we're using permanent whole life insurance. And the reason that these companies, even though they don't guarantee it, they've been able to pay, you know, dividends uh, every year consecutively for over 100 years. It's because they are conservative investors and they invest in U.S. Treasuries. And so those are bonds, and you're already exposed. So even if whether it be 40% or, now 2020, dividing that 40, split it in half, some of it bonds and some of it precious metals like gold and silver, you're already exposed to the bond market, so you don't need to do it again in an investment portfolio like your 401ks and so forth. If you took that 20% and allocated it towards a permanent whole life insurance policy. So, and I'm not saying stop here. You're going to see that gold and silver have outperformed, so to speak, inflation. If everything was done right, if timing was perfect, you would have outperformed even inflation. So I can talk more about that if you have questions, and question me on that, and actually ask me about the house my parents bought in 1960, and we'll go from there. And I'll tell you that you'll clearly see that precious metals, gold and silver, has outperformed, um, or done, protected you even more than just keeping you even with the devaluing of the dollar through the printing of new money out of thin air. But enough of that for now. But I do want to, before I get into this slide, which you've been probably looking at, I want to show where he's coming up with some of these numbers. When the S&P was down almost 57% between the fall of 2007 and the spring of 2011, pre-1933, real money that our founding fathers had put in the Coinage Act of 1792 with exact weights and measures of our money, and that Congress was the only ones that could actually mint that money. They're not even doing that now. FDR, um, Franklin Delano Roosevelt, when he told people they had to, stop, hoarding your gold, hoarding your cash, uh, he stopped making those coins. And that's why they're rare. So they not only have real money, but in downturns in the economy, these perform even better than anything that's out there for gold and silver coins, or, you know, bullion, rounds, and all those types of things. So you can see this 489%, that, it's over 4.5 times increase. And I'll show you what Ryan was talking about in the slide I wanted to show you. So how much should you allocate to gold and silver? Enough to make a difference. Well, he took $1 million and used the 2008 to 2011 time frame. And he said, if you had 90% of your portfolio in the stock market, with the S&P 500, well, then 10% could be put towards gold and silver. So if you had had 10% in gold and silver, your 90%, he used a little bit more conservative number during that period of time from '08 to 2011. And he said you lost 40%. Well, you just saw some people lost 57. Not everybody lost 40, but most people lost 40%. And it took a while for them to ever get back to even. Never mind like making up for what they, all the years it took to get to even on a nominal basis. So you've got 900,000 with your 10%. You've got 90% represents 900,000. You lose 40%, you lose 360,000, you're down to 540. Your 100,000 in gold and silver went up 4.5 times roughly. So it went up to 445,000. And so your total portfolio did lose, but it stayed pretty even. If you had no exposure to gold and silver, then of course you would have, say, in this situation, gone from $1 million down to 600,000, right? So now, because you diversified with gold and silver, you only lost 1.5%. But if you moved it from 10% to 20% allocation in gold and silver, now your 80% is 800,000. You still lose the 40, so you at least lose 320,000, but your 200, your 20% of the million, increases, 4.5 times. And so your 910,000 plus your 480 that, your stocks went down to 480, 480, 910, that's just short of $1.4 million. It's just short of a gain of 40%. So 39% increase. And that is the difference between, well, how much should I allocate? Well, there's nothing saying that, well, we can run the numbers. If you had allocated 30%, you would have done even better. So nobody's saying stop at 20% because that is the real money. And because even though gold doesn't necessarily in itself become you know, worth more, have more value, but in dollar terms, it does because it goes in the reverse direction as we need more dollars to purchase the same thing. Same with houses. My parents paid $13,000 for a house in 1960, and that house would probably, anywhere from 400 to 500,000 to purchase it now. So, it wasn't that the house became more, more valuable. It just took more of those dollars. So you know what I'm talking about. And so I want to look at one more thing that I think is pretty fascinating, which is he took an example of timing the market. And again, back to real estate, many of you are interested in real estate and invest in real estate beyond your primary residence. And he took the example that in 1970, when Richard Nixon was president, he took a house that was worth 25,000 and he sold the house. Now, you might have a second house, let's just say a camp at Lake Winnipesaukee in New Hampshire. Uh, and you took that 25,000 from the sale of your house and bought 700 ounces of gold. And then, in 1980, 10 years later, Jimmy Carter's president, and you sell the gold. You sell your 700 ounces. Now that 700 ounces is worth 730,000. And you buy, let's just say, 12 houses at $60,000 a piece. So now you still have your 730,000, but it's in houses. 20 years go by, we got dot-com bubble, and that burst. But you took that 730 or those 12 houses and you sell them, and you can sell them for 2.4 million in 2000. And that's, rough, as you can see, it's exactly $200,000 average house. And I clearly know that that was happening as I owned a home at that time. And so you sell those 12 houses and you take that 2.4 million and you buy 9,600 ounces of gold. Now, fast forward to the great financial crisis in 2008, and you take that 9,600 ounces of gold and you sell it and you buy houses. Well, you can buy with $18 million worth of gold, you can buy 83 houses back in 2008. You can do the math, you can figure that out. But first administration, the Trump administration, you go and you sell those 83 houses in 2020 and it's worth $30 million now. Those houses are worth 30 million. And then you sell those houses and you take that 30 million and you buy gold. And in 2020, 30 million would get you 21,175 ounces of gold. And then, fast forward 4 years later, in this example, it's all hypothetical, but this is actually kind of what happened and the numbers play out. You take 21,000 and you're sit of gold and you're sitting on 57 million. So this all happened from that one sale of a house back in 1970 that gave you $25,000 to go off and buy some gold, right? So you can see that you bought 700 ounces, but now you've got 30 times as many ounces of gold. And that gold, because of the decreasing value of the money, now you need a lot more dollars to buy an ounce of gold. And yeah, $57 million dollars really for a $25,000 investment. Even if you got a quarter of that, um, most people aren't going to be able to turn 25,000 into that in 55 years. So I just wanted to run through that. So this is just my commentary. I hope you reach out and ask me questions, put comments. Yeah, but either put comments in the comment section or give me a call, email me. You know how to get in touch with me, and I really appreciate you listening. And I'm going to shut this down. Let me just get to that. Have a great night. Thanks. Bye. Day. Night.